Alrighty, so today we're going to be continuing our topic on cover call assignment. Now the previous video which I created was on how to avoid assignment, but in this video we're going to be talking about what happens, what do you do if your cover call gets assigned. So I'm going to share with you a few methods that you can do if your cover call gets assigned and your shares gets called away. So first of all, what happens during a cover call assignment? So most of the time, right, when your cover call is in the money at expiration or near expiration, when there's very little extrinsic value left, there's always a chance for you to get an early assignment. So that's where your cover call will get assigned and then your shares will get called away. So it's 100 shares per cover call. So at this point of time, actually it is a good situation because chances are that you may have bought here and the market went up and then you are actually in a profit, but you might want to continue to hold on to your shares because you think that the market is going to continue to go up. Right, so what do you do then? So there are a few things that you can do. So right now, let's say for example your cover call is in the money and it's yet to be assigned, right? I've spoken to some people say that they want to actually close out the cover call for a loss so that they can still hold on to the stock. Now I don't really suggest this unless you are really bullish on the stock, right? You think that the point in time where you closed out the cover call, the market will still continue to go up. Then if you feel that's the way, then yes, you can close out for a loss on your cover call. But you have to understand one thing is that the stock doesn't actually go up in one straight line, right? It doesn't do that. Stock will always move in wave patterns. So it will come down, consolidate a little bit, go back up again. So at the point, let's say for example, if you bought at this point and then maybe you sold a covered call at this point, right? So at this point of time, if you saw a cover call, the market goes all the way up here, then you decided to cut loss on your cover call, chances are this may not be the best move because the stock can always come back down, right? So for example, in this case, if the stock comes back down to this point, if you had held your cover call, what you could have done is just roll out and up, right? Add more time to it and then see if you can roll up to a higher strike price. So in this case, you can always keep the cover call and you just keep rolling up. Just keep rolling as much as you can rather than to take a loss on the cover call, because if you were to take the loss on the cover call and then the market kind of retraces back again, then you kind of regret taking a loss on the cover call, which defeats the whole purpose of selling the cover call in the first place, right? So if you are in this situation right now, then maybe it's better for you to just wait for a retracement and then to roll your cover call up and out, right? If you cannot roll up, you can just continue rolling out and then see if the market comes back down again. So your two methods for this, you can roll your cover call out and up and then to roll out. Right, so what if you're already assigned, right? So the first question you want to ask yourself is, are you still bullish on the stock? If you're not sure, right, if you don't think it's going to go up, then there's no point to re-enter into the stock again. You can just go and find another stock which you think there's a chance for it to go up. There's many things you can do with your funds to find another trade setup. There's no need to go onto the same stock. But if you are still bullish and you think that the stock is still going to go up, then you want to re-enter into the stock. There are a few different methods that you can do. So I'm going to share with you 4 methods. The first method is to just simply buy back your stock. So for example, right, if the current price right now is down here and then your cover call, you got assigned down here, your shares got called away here. If you think that the stock is still going to go all the way up, then you can just simply just buy the stock outright, right? If you think it's going to go up, there's no harm buying back right now. And then although you're losing this much in terms of the gain of your stock because your shares have been called away here and then you're buying here, right? It's not that much of a big difference if the market is still going to go up. So especially if you're buying this for long-term holding, you're going to hold on to your stock for the next 5-10 years, then there's really nothing wrong for you to just go outright and buy the stock. Now if you don't feel comfortable buying at the current price, you think it's a little bit too high, you can see the stochastics here is overbought, you can just place your buy limit order simply at a place where you had your cover call assigned. So this way, if the market comes back down, you will be filled on this and it's as though the cover call didn't happen, right? You still managed to get your premium on the cover call and you resume back this position. Now of course this is the best scenario. Next thing you can do, instead of buying at the current price or just placing a buy limit at where the cover call is, you can actually just wait for a pullback, right, to see the stochastics, to see whether it's oversold. So at the moment right now you can see it's overbought, right? If the market goes to the point where it's oversold, right? There's a good chance for it to be a turning point. So if the market comes, let's say, below where your cover call got assigned, you could actually buy it at a better price than where your shares got caught away. But if the price, let's say, comes down to here and you see that the stochastics is oversold, then you could, make a case to just buy your stock down here as well, right? There's nothing wrong with just buying the stock if the market is going to shoot back up later on. Now, the next thing you can do is to split the order into several buy levels. So if you don't feel comfortable, just buying the full lot size which you have, the full 100 shares, or how many shares which you have at the current market price, then you can actually split them into different levels. So this way, you actually still have some skin in the game in case the market shoots up, right? It's because you at least still have 25% of the shares which you got caught away. If it goes up, you still make a little bit, but in this case, if let's say it goes down, right, you do not get all your shares at the current stock price. At least you wait for it to go down, you buy a little bit as it drops, buy a little bit more as it drops. So if it goes down to level 3 and then it goes back up, at least you have a pretty decent average price at somewhere around buy level 2, right? If it goes all the way down, even better still, right? So in this case, right, you're kind of like managing the balance between the different ways of entering the stock, right? If you buy at the current stock price and then the market doesn't goes up, it goes all the way down, you kind of feel a little regret of buying too early. But then if you buy at the limit order, you place a limit order at the cover call strike price and it never gets there, comes down and goes all the way up, you kind of regret again because you have no skin in the game. So the best thing, if you're feeling that way, is to just simply buy into, split into different buy levels. Now, method number 2 would be to re-establish your cover call. You can just simply re-establish the position which you previously had by just buying the stock outright at the current price and then selling the cover call at where your cover call got assigned. So in this case, you're actually resuming the position. So what you want to do here is to sell a cover call that is a further dated one. So maybe, for example, the cover call that got assigned, maybe it had 20 days to expiration. So instead of selling the 20 DTE which got assigned in the first place, you don't want to do that. Because if you were to just sell the cover call with 20 DTEs left, it could just get you assigned again. So what you want to do is sell a further DTE instead. So you want to go for maybe somewhere around 45 DTE. So this way you pick up some extrinsic value as well. And you also gain back all the intrinsic value which you have lost between this point to this point, right? So some of you might be worried, you're saying that if I buy at the current stock price and your shares got caught away at this strike price down here, would it mean that you would have lost this amount? Now, you wouldn't be losing this amount if you sold the cover call at this strike price, because you're actually regaining back the intrinsic value which you lost by selling this cover call, right? So by selling the cover call at the same strike price, you recover the stock's intrinsic value that you lost. So here's what I mean. So for example, this is the stock price right now. You can see the last price is 254.51, right? The bid is 254.53, 254. Now, if you take a look at the intrinsic value down here, it's trying to say that the price of the stock right now is around 254.53. So let's use this price as where you will be buying the current stock price right now. So if you were to buy the current stock price right now, it's 254.53. And let's say your cover call, let's say you got caught away at 240, right? 240. So we'll be looking at this column, this row down here. So if you take a look at this row, if you were to sell this price, what you notice that is you will be selling at $18.35. So if you think about it, the stock price, the current stock price and the cover call strike price, the amount which you actually lost, the difference, is 254.53 minus 240, which means it's $14.53. You lost $14.53 on where your shares got caught away and where you're buying the stock price. But if you take a look at the price which you're actually selling this cover call, you're actually selling at $18.35. So you're actually getting more than what you lost. Because when you sell the cover call, you will see that it actually has an intrinsic value of 14.53. That means when you sell this cover call, you're actually regaining back all the intrinsic value that you have lost from this point to this point, and on top of that, you still have an extrinsic value of $3.82. So in this case, you are fully resuming back the position which you did, and you're adding on some extrinsic value as well. So at this point of time, The only messy thing, or the thing that you might find it awkward or hard to really comprehend, is the stock price. Because when you take a look at the stock price compared to before, you may have had the stock price somewhere down here, but if you buy the stock price at the current price, your broker will be showing your price as this current strike price, which is 254.53. So if the market was to go down somewhere down here, you might see a loss on your broker, but you're actually overall in a profit because your original price is here, which you had already taken off the profit from this point, right, to down here. So this is one thing you want to take note of. But overall, this whole position is exactly the same as you would have if your cover call previously did not get assigned. The only difference is that you had already rolled out with extra extrinsic value of $3.82. So this is how you can re-establish your cover call. By the way, if this video has been helpful so far, I appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Alright, so method number 3. Method number 3 would be to sell a cash secured put, right? So you can just simply sell at the same strike price where you sold your cover call previously. So this way, if the price doesn't reach past your cash secured put and the price continues to go up, at least you still are able to get some premium from your cash secured put. Now, if the cash secured put, which you want to sell at where the strike price for the cover call is yielding too little premium, doesn't give enough premium for you to collect, then you can just choose to sell a 30 delta cash secured put, right? So maybe a 30 delta might be here, or maybe it might be here, right? Wherever it is, you can just sell a 30 delta cash secured put so that you can get some premium. So in this case, if the market goes down, right, it's easier for you to get a sign on this cash secured put, which is what you want because you want to resume this position. Right, so you can just sell a 30 delta cash secured put if the strike price which you want to sell the cash secured put at doesn't give you the kind of premium which you want to receive. Now, instead of selling the cover call straight away, you can of course just wait for the stock to pull back. Right, you can see that the stochastics is overbought, so there is also a chance that the market can come back down. So if it does come back down, you can just wait until it gets close enough, then you can sell the cash secured put at where your previous cover call was. So this way, right, if the market goes down, you will be able to get back at the same price at which your previous shares got called away at. Finally, you can do it the same as how we did in the buying the stocks outright. You can just split it into several cash secured put, right? So let's say, for example, you had 300 shares called away. If you had 300 shares called away, you do not have to sell all 3 cash secured put at one level. You can split them into different levels. So it's the same psychology as splitting into different tranches. You can sell one cash secured put at 50 delta at the current stock price. So this way, if the market does shoot up, you don't get a sign. At least you still get a pretty decent premium. Or if the market goes down, right, you don't have to put all your eggs in one basket, in a sense, where you don't have to sell all 3 cash secured put at the current stock price. You can wait for it to drop and then sell another cash secured put as it goes down, and then sell another cash secured put again. So again, you're splitting up into different buying tranches. Now, the last method would be to sell a put ratio spread. Now, previously I've already created a video on a put ratio spread. You can go ahead and watch that video. I put a link at the top right hand of the corner. But basically, you can sell a put ratio spread, which is a good way to buy into stocks, right? So a put ratio spread basically is to buy 1 put option and to sell 2 further out of the money put options. So the way you want to see this is having an embedded bear put spread. So a bear put spread is where you buy 1 put option and then you sell a further out of the money put option, and then you sell 1 additional cash secured put. So basically, it is 1 bear put spread plus a cash secured put. Now, the put ratio spread is very flexible, very versatile. You can split them into many ways. So instead of doing this, maybe you might want to put your buy put down here plus 1, and then maybe you want to put your 2 put options down here as well, sell the 2 put options. So it's up to you to adjust the strikes however you want. So it's very flexible in this way. So ideally, what we want is to try and get our cash secured put portion of the put ratio spread to be in line with the cover call strike price, because this way you'll be able to get back your shares at the same price at which it got called away before. But there are times, you can't really arrange it so that your cash secured put is here, especially if your stock price is too far away. So in this case, you might want to split up the short put option. So here's what I mean. You can sell your cash secured put at the same strike price at where your cover call was. So let's say, for example, you receive maybe $2 in credit for this. So if you receive $2 in credit in this, you want to try and find, the strikes where you are buying the bear put spread. So you want to have your long put at the money. So this way, any movement down, right from the current strike price, you'll be able to make some money on your bear put spread, rather than if you were to put your bear put spread starting from this point all the way to this point. So the market has to drop lower in order for you to profit in your bear put spread. But if I were to put my bear put spread at the money, this way, if the market just drops a little bit and it expires here, let's say at expiration it expires here, it doesn't get to my cash account put, in this case at least I will still be able to make the money right from here all the way to here. So the whole idea down here is you want to adjust your bear put spread to see how far of a strike, how far you can get in terms of the width of this bear put spread with this premium. So sometimes you may adjust back and forth. Now ideally, of course, you want this -1 put down here to coincide together with this cash account put, so this way you have the biggest profit from here to here. But many times, if your strike price of the cover call, right, of the cash account put where you want to be aligned with the cover call is too far away from the current stock price, chances are you're not going to get quite enough premium for you to make such a wide bear put spread. So that is why you want to try and measure or try and adjust it to see how far of a width that you can get. So generally what I like to do is I will find the strike that's at the money for the put that I'm going to buy, and then find the furthest put I can get for roughly the same debit as the credit which I received. So roughly I'm looking for a debit of around $2 as well. So this way net they will cancel out each other. So the whole put ratio spread you can put on for $0 or for a slight credit. Alright, so that is for method 4. Okay, so let's get into some takeaways. So if you sell cover calls long enough, there will be times where you can't avoid an assignment, right? If your shares are caught away, it's not the end of the world, because you got to understand that the stocks don't go up in a straight line. You can always get it back after the stock get assigned, right? Your stock gets called away, because in the long term, if you're bullish, as long as it goes up from where you re-entered, you will still make money. So there are 4 methods. There are 4 methods to re-enter into the stock. So the first thing is you can buy back the stock directly, right? So this is the easiest and the simplest way to ensure that you actually get back into the stock in case the market goes up. Now, method number 2 is to simply just re-establish the cover call. That means you just buy the stock at the current price and then you sell a further dated cover call at the same strike price. So this way you're resuming the position, and then you still add on some extrinsic value as well, so it wouldn't be called away so soon. So at the point of time, you can always just keep rolling once the extrinsic value gets lesser, or when there's lesser time left in the cover call. Now, method number 3 is to sell a cash account put. Many ways to sell the cash account put. You can go back to see that section on it again. And the final method is to sell a put ratio spread. So this way, if you get assigned, you get paid on the way down, and then you still get back your original stock position as well. Alright guys, so I hope this video has been helpful to you, and if it has, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.